Awesome. Looking forward to have our chat, Philip. This is like so grateful that you can be on this call with us this morning. We're going to do like move on in a few minutes with a formal presentation, but very, very thankful that you can take this call for us this morning. I know you probably have many inquiries this morning, especially with the event in the last 48 hours.
Yeah, we'll get into talking a little bit more of it, but as you can imagine, yes, it's been a very interesting and fast moving time just the last couple of days, especially with yesterday everything going on. But we'll get into it a little bit more as we go on in the presentation. I don't want to spoil anything right away.
That's awesome. That's awesome. No, there's definitely a lot to talk about, a lot of noise. What does that mean? What's just noise and what's facts and what's reality? I think that's, actually, to some extent, that's what the clients are looking for. That's what individuals are looking for. Try to make a difference between facts, reality, and just noise. I'm looking forward to have a good conversation with you. Well, we already three after. I think we've got quite a few people on the phone already. So I think I'd like to get a little officially a little started. Let me try to get my screens moved on here. Uh, try to um, try to follow this up. Okay. There we go. Officially welcome everybody, and welcome to our little webcast, live webcast with our guest Philip Petursson. So looking forward to have Philip on our call this morning. But before we get into this, a little bit of housekeeping for everybody. Please keep in mind that everybody's mic has purposely been muted, and while cameras are off for everybody. So if you've got little issues with your browsers or Teams, or it just freeze, either reset your browsers or log off and get back in on the link. If the link's not working or something's going on and you need the new link, Aaron is on standby here for any calls or emails. Please call the office or email her directly, and we'll send you the link right away. Throughout the presentations, James will also be monitoring the Q&A. Q&A button is on the top right corner. You'll see Q&A. Any questions throughout the presentations, please do so. Put your information in. We'll probably have a discussion throughout the event, but if any case, James will be on standby. We'll be monitoring all the questions, and we're going to try to feed the questions as we go through. This is meant to be a fireside chat, and you'll see in a minute that Philip Petursson's got wealth of knowledge, wealth of information, but his huge personality, and it's beautiful, he's a great communicator, and we're looking forward to having presentations with him as well. As we move on, before we get started, and before we move on with today's business agenda, I think it's important for us to acknowledge that we're grateful to have this opportunity to work in this community, and also recognize our many colleagues from working from many places near and far, acknowledging the traditional owners and caretakers of those lands as well. It starts with acknowledging our past, and we would encourage you and invite you to be curious and learn about the caretakers of your community. This has been many times before where I've had many discussions through a conference and national calls at private wealth conferences that I've had the opportunity to meet Philip, and you'll see in a moment that Philip's will maybe not need any introduction by many of you, because he's a very regular guest in the media personalities nationally, on BNNs, on the media. And Philip Petursson's, first and foremost, is IG's chief investment strategist. He's a veteran of the wealth management industry, having spent over 25 years working from a prominent financial institutions in various of senior roles. Philip most recently served as chief investment strategist and head of capital market research at Canada's largest insurance company, where he managed capital market strategies and developed investment recommendations for financial advisors. He's also hails from McMaster University, where his son also currently attending, and he's an award-winning podcaster, having produced and appeared in over 60 some segment in the last 3 years. without further ado, very, very pleased to have Philip here on our call with us. Welcome, Philip.
Thank you, Sylvain. It's a great pleasure to be with you this morning and to talk on all things markets and all things investing. Really looking forward to the conversation.
Great. And I've said, actually, I did say that to, actually to many clients. This is a very, very opportunity for us to be able to have the wealth of information and knowledge to have people that supports us on a day-to-day basis, people like yourself. But also, over and above the knowledge, the information, have the ability to communicate. I think it's probably one of your best fortes. So I'm looking forward to having a discussion with you guys to translate it, actually with you this morning, and translate what has transpired in the last 40 to 48 hours. We're going to have an agenda, Philip. As you know, we're going to talk about a little bit about the global economy, central bank policy a little bit, the broader economy on the fixed income and the equity markets. Obviously, the elephant in the room post-elections in the last 48 hours. But let me get right off, like many would say, south of the border. Let's get off script right away. And I'd like to take 2 seconds there. 2024 has been extremely strong results on both sides of the ledger, on fixed income sides, on the equity sides. And I remember very quickly that 2024 didn't start off the pat very quickly. We had obviously a lot of concern about inflations, interest rates, equity valuations actually were questions. We even talked about recessions. So this and geopolitical mess, obviously with Ukraine and whatnot throughout the globe. But despite all this, 2024 was extremely strong results, upwards to double digits return. Can you touch base? I don't want to rehash the past too much, Philip, but can you reiterate a little bit what provided to those strong results last year?
Sure. I think it comes down to a better economic environment. And if we go back 2 years ago in 2023, there were concerns of a recession in the United States, although we didn't see many signs of recession. The way we described it was 2023 had, say, a rolling recession. We had recessions in part of the US economy, but not the whole. So we saw manufacturing slow down. We saw housing slow down. For a brief period of time, we saw retail sales slow down. But this didn't lead to a full-blown recession. And what a full-blown recession includes is high unemployment. And you didn't get that. And the reason we didn't get that is because we're in a we're seeing a demographic shift where we have a number of baby boomers that are retiring, and those that are coming into the workforce aren't replacing them. So we don't have as many people coming into the workforce as those leaving. So that's kind of the challenge or not challenge, I would say the opportunity that we've seen. I apologize. That's my computer going. My team is pinging early in the morning. So when we think about what happened in 2024, well, we were set up for, if you want to call it a soft landing, but let's just call it an improving economic environment where corporate profits were increasing, recovering off of the minor pullback in profits in 2023. And we did have a positive investor sentiment that helped drive valuations higher. So it was a combination of two things. Strong economy and markets that were responding to that led to the gains that we've seen in the marketplace, not only in the United States, but we saw it in Canada, we saw it in other areas around the world, and we saw it in fixed income. And that's as interest rates on the shorter end of the curve came down and the longer end of the curve started going up. So, all in all, good year. Balanced investors saw returns in double digits. Equity investors, higher than that. Even conservative investors on a year-over-year basis saw a very, very attractive return on their investments. So, it's one of those things that they happen more often than we think. And it was a year that was better than we expected.
It's also good to see a little bit of return on the fixed income side, because it's been a while since we had what I would call positive return on both sides of the ledger in fixed income and equity. So it's actually good to see a little bit more, rebound on the fixed income side.
That's exactly it. And this is, we call it a normalization of the fixed income environment, where long-term interest rates are hovering in the 3.5% to 5.5% range. And shorter term interest rates, as we know with the Bank of Canada, they're coming down. And as those short-term interest rates come down, that is providing some relief for those borrowers out there. But longer-term interest rates are providing a suitable and an attractive income to conservative investors that are steering their assets towards bonds that are paying them in a mid-single digit coupon or yield that is delivering a return to where we were, say, 20 years ago in terms of what we expected out of bonds.
That's a very good point, and I'd like to get back to that a little bit later on because there's like the last 2 or 3 years, there hasn't really been an appetite to be like too much underweight, if you will, in equity side or overweight in fixed income because of lack of possible return. But now that the appetite has returned, I'd like your thought on that as we move forward towards the fixed income and the interest rate, where we go from there. But why don't we go back to where do we stay right now? What does that mean for 2025, and where are we going from there?
So far in 2025, what we see is a continuation of what we had in 2024. Now, we have to be careful here, Sylvain. So what we don't want to do is extrapolate the returns that we had last year to say, well, we should just expect another 20% return out of U.S. equities this year. It doesn't work that way. It's a combination of valuation and earnings growth. And so by earnings growth, we mean profits. How much are corporate profits going to grow year over year? And here, we have a positive outlook. Not only our indicators, but what we're hearing from analysts out there is setting the expectation for profit growth that's going to be in the 10 to 12% range for U.S. companies, Canadian companies as well. And so when you look at that, you go, okay, so that's our starting point. We should see gains in the market, like positive gains in the market because profits are growing. The offset to that is valuation. And valuation, we can measure it in a number of different ways, but let's put it this way. Last year in 2024, a lot of the gains that we saw in the market were because prices were just going up and it wasn't necessarily earnings driven. Corporate profits were up about 7%, and yet the S&P 500 was up 23. Well, how do you get 23 out of 7? Well, the difference is just the valuation in stocks going up. So usually when you see a year like we think we're going into in 2025, when profits now are going to be in the double digits, you tend to see valuation come down. So our expectation is that, while we do see a good environment for profit growth, the total return on stocks is probably going to be somewhat less than that, closer to average, which is in that 8 to 9% range. So we think that mid to upper single digits for U.S. equities is realistic. Canada, I think, can actually do a little bit better because we're cheaper than the U.S. and we have some upside catalysts with the banks, energy, materials that could see a more positive year. In part, and we can get into a little bit later, in part because of the AI boom that's going on, not only in the United States but globally.
It's interesting, and part of like it's not always like what's the best is more like from a starting point where the valuation is. Correct?
That's exactly it.
Okay. And as we go into this, and all the profits are adjusting for 2025 and ruling moving forward, like how does the Bank of Canada and the central banks like adjust this? Like where do we go from there?
Okay, great question. So the Bank of Canada and the Federal Reserve in the United States are more focused on the labor market. So where is unemployment? What does the job growth on month over month look like? And then how is the general economy doing with respect to growth and inflation? In Canada, we have lower inflation. Our inflation rate last print was 1.9%. If you were to strip out shelter costs, which is like rents and mortgages, well, that actually comes down a little bit. And so inflation in Canada, excluding shelter costs, is hovering closer to about 1% or even below that. And so this is allowing the Bank of Canada then to cut interest rates faster than what we see in the United States. And there's another reason for this too. Our economy is not growing as fast as what we're seeing in the US. So we're at 3.25% for the overnight rate in Canada. We think the Bank of Canada is going to continue to cut and take that to 2.5%. So we see 3 more cuts out of the Bank of Canada through this year. In the United States, where inflation's a little bit higher, their economy is growing a little bit stronger, we think that the Federal Reserve is going to continue to cut, but they're only going to get to 4% for their, call it, overnight equivalent rate. And so that actually, it's not a bad thing. And in Canada, it's a good thing with shorter term interest rates coming down. Again, it's going to provide some relief to mortgage borrowers, some relief to borrowers in general. You can see on the left-hand side there, where we have the target for the Bank of Canada at 2.5. At the When we created our 2025 outlook, we thought that the Federal Reserve might be a little bit more aggressive in their cuts and cut to 3.5. We've dialed that back, so we actually think 4% is where the Federal Reserve is going to end up being done with its interest rate cuts. On the right-hand side, what we're trying to show here is that we shouldn't expect aggressive cuts out of both the Federal Reserve or the Bank of Canada, because we're not in a recession. When you're not in a recession, the bank tends to cut less. Only in a recession do you need like emergency stimulus, which would take interest rates to very, very low levels from their pre-recessionary environment. So good news is rates will still come down. Bad news is they're not going to come down to where they were pre-COVID.
What does that mean, Philip? And I've heard your podcast, and I've seen a couple of articles, and you're calling like the new normal. Like, is that okay to expect that we're not expecting much movement on the downwards, but we're not expecting anything increase? Are we pretty much staying where we're at right now for the foreseeable future?
Exactly, and that's what we think. So we joke in our outlook. We call it the new normal. If post Great Financial Crisis was the new normal of ultra low interest rates, we're not going back to there. So where are we going? Well, we call it the new normal, and guess what? It's a lot like the old normal, which was pre 2010. So let me give you an example for this. 20 years ago, inflation was running at about 3% in the US, where it is today, right? The 10-year yield in the US was running
3%.
between 4 and 5%. Guess what? That's where it is today.
So
So
this is
that's
like
what we're seeing.
that's what we're saying, and this is good to understand, because a lot of people sometimes we're moving forward. Everybody thinks it's new all the time. It's new, like the capital market has been around for a long time. So there's a lot of things that it's not new. It's just there's a lot of new economic conditions, but perhaps the old new, it's a little bit of sign of stability to come. What do you say?
Exactly. That's exactly it. And we joke, you and I think we're of the same vintage, and we remember when inflation and interest rates were running at 3%. And, my student loan when I came out of university was at 9%. So, this is what we knew. Anyone that came into the business in the last 20 years, well, they only know like effectively a zero interest rate policy. They know ultra low interest rates. They haven't like lived through sustained higher inflationary periods. Guess what, though? We're not expecting that. The inflation that we saw, say, 2 years ago of 8-9%, that's not going to return anytime soon. That was a COVID-driven factor. Now, though, when we talk about a normal rate of interest, well, that's 2.5% target for the Bank of Canada overnight rate. Longer term interest rates are going to be between 3.5% and 4% in Canada, 4.5% and 5% in the United States. That's where we should be. This is a great chart here too, because this explains why then the Canadian dollar is where it is. So I don't know if you want me to just jump in there, Sylvain, and kind of go
That
to
was
it.
going to be like you did the bridge for me. That is like usually when we're talking about interest rate, like then the next discussion is like, what does it mean with a Canadian dollar, and obviously we've seen the currency and where it has been. Where do we go from there? What does it mean on both sides of the border?
Right. And this is something that I think everyone can take away from, in that how do we square where the Canadian dollar is with everything else that's going on? People will say, "Oh, tariffs, that's got to be bad for Canada, the Canadian dollar." Think about politics, that's got to be bad for the Canadian dollar. In reality, the Canadian dollar is only moved by really two things, and it's the difference in interest rates between Canada and the United States, and oil prices. Now, oil prices have had much less of an effect on the Canadian dollar since COVID. We're not exactly sure why, but the correlation between oil prices and the Canadian dollar is broken down. Whereas the correlation or the relationship between interest rates and the Canadian dollar has gotten a lot closer together.
Closer.
And
Okay.
so here's how or here's why this has happened, why the Canadian dollar is sitting at shy of or just above 69 cents today. It's because US interest rates are higher than Canadian interest rates. So what that is doing is it's attracting Canadian bond investors out of Canada, buying US dollars to buy US bonds and generate a higher coupon. Okay. When that happens, it pushes downward or puts downward pressure on the Canadian dollar. And so that's where we are today. The difference when we talk about the Fed being at 4% for the overnight rate, Canada being at 2.5%, that 1.5% difference leads us to a Canadian dollar at 69 cents. And so we think it's going to stay at that range. So the difference is going to be about 1.5%. And so we think the Canadian dollar, the volatility in the Canadian dollar is probably done. The downside risk could be as low as 67 cents, but we're not entirely sure we're going to get there. We think we're going to be stuck at the 69-cent range. We're not going up anytime soon unless the Bank of Canada is going to raise rates aggressively. And so let's go back to when the Canadian dollar was worth much more. We're talking like more than 10 years ago. And the reason for that was that interest rates in Canada were higher than interest rates in the US. Coming out of the great financial crisis where the Fed took interest rates to zero, our rate was still higher than that. That's why the Canadian dollar was worth more. Now we have the opposite effect.
This is awesome, and that's going to be obviously like the next topic, which we touch base on it, which we touch on it a little bit, and especially as a balanced investors or more conservative investors, it has been a challenge in the last 3 to 5 years. We've had through the dog's years through after COVID, 2021, 2020, 2021, 2022, even 2023 was almost very little to no return, with the fixed income being as low as they were, as the interest rate being as low as they were. Now, obviously 2024, a lot of people saw the market come back. Most individual thinks that the return has been solely based on the equity side, but in fact we've seen 8 to 10% rate of return on fixed income side. Where do we go from there?
Right. So the best way to think about fixed income is what's our starting yield? Like what are our bonds paying us to hold them today? And we're generating close to 5% out of bonds in terms of the coupon and the capital gains embedded in the value of the bond itself. So that's a great starting point to say, okay, historically, your forward 7-year, 8-year return is what your yield is today. So we should expect a compound return on bonds in that, call it 4.5 to 5% range. And this is, the new regime for bonds that we're in today. And you can see how so the red line is the average yield for the US 10-year Treasury. And that's like a nice benchmark for what we should expect out of bonds. And you can see how it's been coming down over the last number of decades. But now we're at that point where it's hooked up and hovering closer to 5%. And we think it's going to stay around 5% for the next year. And so that sets expectations that, yes, bonds should pay us a mid-single digit return. But here's the kicker. Now that we're generating a yield out of bonds, they should also provide a decent amount of downside protection if we were to see equity market volatility or economic risk emerge in 2025 or 2026. So bonds have become defensive like they were pre-COVID.
And on the defensive side, still justify its purpose in providing investors a decent yield to hold bonds.
Absolutely. You're getting paid 5% while you wait. I'm getting paid 5%. Inflation again in Canada is running sub 2. That is an attractive real return that you're generating out of fixed income.
That's a very, very good point. Let's go a little bit off path here and a counterproductive point, a counterintuitive point. If we have robust, like obviously low unemployment, growth equity, and economy still moving ahead, do you see at all any inflationary discussions where Bank of Canada could actually still maintain the interest rate and even like go back up a little bit?
So not in Canada. When we model out inflation in Canada, we see it hovering around 2%. Right.
Which is the ideal part of where they want to be.
Exactly. Remember, the Bank of Canada is targeting inflation at 2% plus or minus 1. So we look at where inflation has trended over the last 6 months. We put in some assumptions. And so it's going to be very difficult to get inflation higher than 2.5% in Canada. There is a caveat, and we can talk about the potential for retaliatory tariffs in a bit. That's one of the unknown factors. But inflation in Canada is still going to remain quite low. In fact, the risk is that inflation could fall below 2% because what we're starting to see, 30% of the inflation calculation is what we call shelter cost.
Yep.
Shelter cost includes mortgages. And as we know, mortgage rates today are a lot higher than where we were a year ago, 2 years ago. But as that kind of rolls off, then inflation starts to come down. So the big impact of the mortgage rates is behind us, less so in front of us from an inflation perspective. Now in the US, so let me just in the US, we do see inflation higher. When we model out inflation in the US, we see it sticking around at 3%. And
Okay.
here too, the caveat is if Trump wants to throw tariffs on everything, that's inflationary to the purchaser. And so that's where we could see even higher inflation in the United States that could result in the Federal Reserve pausing, or perhaps, depending on how high it goes, raising rates. Less so of a risk in Canada, more so of a risk in the US.
And that's a good point, Philip. I was just as you were saying here, in some time on a retail play, like people asking, like, what do you think of interest rate? And sometime, please, like, actually let me know. But I always say, like, don't follow interest rate. Interest rate are the lagging indicator to follow inflation. So what we should really pay attention is inflation, not interest rate.
Exactly. That's exactly it. The Bank of Canada responds to the economy and inflation after the fact. I mean, look how long it's taken the Bank of Canada to get the overnight rate to 3.25%, which we would argue should have been done perhaps a year or two ago. So it is very much a lagging indicator.
And moving on from there, like where do we go from obviously from the equity side? We've had obviously high double digit, like even like 22% digit and equity return in 2024. Where do we go from there, and where's the valuation sits right now?
Right. Great question. So the other consequence to inflation and interest rates where they are today is it has an impact on valuations. So how does this work? Well, stocks are really just very, very long-term bonds. And the profits that a company generates, think of it like a coupon, right? That's the coupon. So what is the value of all those future earnings in today's price? Well, you apply what we call a discount rate on that. The high, and we tend to use the prevailing interest rate. So higher interest rates put pressure or put downward pressure on the valuation of those future earnings. And so that changes the price that we pay per stock. So all this is to say, with the interest rate environment where we are today, we do think in the US in particular that we're going to see valuations come down because of that teeter-totter balance between the two. So it's going to be a good earnings year, but we think that the total return is going to be less than earnings because we're going to get a valuation adjustment. And this is normal. This is very normal for the markets. And here's the great example of what we're looking at. So over on the far left-hand side, the S&P 500, that gray bar is where the S&P 500 has traded in terms of valuation. This is price to earnings multiple over the last 20 years, taking off the top 5% of observations and the bottom 5 because they can skew results in times of recession. So what we're looking at here is 27 times earnings for adjusted for positive earnings for US companies. That's expensive. That is not cheap. And you can see we're in the top 5th percentile of all observations. So as interest rates and inflation are going to stay where they are, they're going to put downward pressure on this. Right. So that doesn't mean the markets will be down. It means of the 12% earnings growth, the market might only price in 6. And then your dividend of 1 to 2% on top of that gives you a total return of 8. Right. And then we'll end up at a multiple of not 27, but maybe 25. Right.
So you're looking for valuations to readjust with the consequent to the growth that we've had in the last 18 months or so.
Exactly. And this is normal. This is normal market activity. When you see earnings drive gains, you tend to see a lower return. And valuation is like a pendulum, right? And it swings and it swings too far to the right-hand side and then swings too far to the left-hand side. So, right now we've swung a little bit too far to the right-hand side and we're going to come back to the middle. And so this is why we think that Canada, that on a relative basis is much cheaper than the US, can outperform.
Yes, we're going back to the word evaluations. When we go
Exactly.
into this, we're looking at what's the outcome for X amount of stocks. Okay.
That's exactly it.
This is good. This is actually really good discussions. Folks, as you can see, when we go on a conference, I always try to say, you know what, Phil, let's have a beer because we really enjoyed it's like this fireside discussions. And as you can tell, Philip is very, very obviously good communicator. And it's good to see the wealth of experience and knowledge that he has and the communication skill that he comes across and makes it a little bit more palpable on a day-to-day basis for us to relay the information and translate, if we could, the information to our client. I think we're ready for obviously the big elephant in the room there, Philip. Now, obviously, when we talk about valuations, we talk about outcomes, we talk about moving forward. Uh, and we talked about interest rate, and it's not following interest rate, it's follow basically the impact of like the in this case was inflation. Oftentimes, we human beings tend to be so focused and so focused towards the noise and the matter at hand. Let's talk about the elephant in the room. What has transpired in the last 48 hours? And what does it mean, if any, for us moving forward?
Okay, so we'll start with the good news. The good news is that I don't know how many executive orders that Trump signed immediately after the inauguration, that one of them was not tariffs. So he said, I think it was a live press conference as well, or he was taking questions from the press. And when asked about tariffs, he said, it could start as soon as February 1st. So this is a big change from what was being said a couple of weeks ago, where day one he was going to put tariffs on everything, not only things coming from China, but things from Canada, Mexico, elsewhere around the world. Now it seems that perhaps cooler heads have prevailed. I said, well, let's study where we want to put tariffs so we can bring a more balance of trade. Now, the reality is, and perhaps you've seen this in the press as I have, that excluding energy, the oil that we ship to the U.S. actually has a trade surplus with Canada. So Canada's not ripping off the United States in terms of a trade deficit. The U.S. isn't subsidizing Canada to the tune of $200 billion. That's just the difference in trade, which is to be expected. We're a country of 40 million people. They're a country of approaching 400 million people. So yes, it makes perfect sense that they would buy more from us than we would buy from them, just because we don't have the same kind of population. However,
I'm going to interrupt you
yeah,
right here, Philip, because I want to take a time to explain this to people because a lot of people obviously emotionally bound by this rhetoric and the noise and the aggressiveness, the bulliness, or call it whatever you want. But at the end of the day, there's certain aspect that they can do and certain things that they cannot do, and it still doesn't make sense.
right.
So that's where when economists and policies are looking into like what does it surplus means and what is it the impact? And what if there is an economic impact? Does it really have any effect for most of us and even the valuations on equities?
Right. So let's take it back to Canada and the United States have a strong trade partnership. 70% of goods that we export go to the United States. The big bulk of that is oil products, petroleum products. And there's other manufactured goods, but other raw materials as well. Think, lumber, think mining, like base metals, precious metals, and so on. And so the U.S. buys 200 billion more of our products than we buy from the U.S. Okay, so what we buy from the U.S. would be finished goods. Maybe it's cars. Maybe who knows what it might be. But that's the way the trade works. Now, this is being misrepresented by the Trump administration already, saying they're subsidizing Canada by $200 billion. That's not the case at all. They're just buying more stuff than we are, right? That's just, the natural ebb and flow of things,
There's
right?
376 million compared to 42 millions. One would expect that.
Exactly. That's exactly it. And by the way, they want our oil, and we sell our oil at a discount to them. And so that's where the trade deficit really comes from. Okay. But from the market, and then the other thing everyone needs to realize is, and this, while the press keeps putting this forward, I don't know if President Trump realizes it or if he just is saying this, but um, the exporting country doesn't pay for the tariff. So then when you buy something from the US and UPS knocks on your door and says, here you go, who pays the duty on it? You do, right? Not the shipper. You pay for that, right? That's a tariff. So really, the burden of the tariff would be on the U.S. Businesses that are buying goods from Canada, Mexico, and other areas around the world. They are paying for the tariff, not the shipper. Now, what the consequence is supposed to be that, well, if I'm going to buy goods, if I want to avoid a tariff, I'll try and either source it from a manufacturer in the United States or somewhere else to avoid paying that tariff. And what it means is our export business would go down and someone else would benefit as a result of that. Okay, that's not necessarily the reality of it because the US doesn't manufacture all the goods that they import. So there isn't a trade-off. So if they're going to put a 25% tariff, that's the only game in town. There's nowhere else to go. Right? So
and would that not cause inflationary pressure even more to the states that they've already have?
Exactly. It would. That's the general opinion in that tariffs are inflationary, tariffs are bad for the economy, tariffs basically go against the free trade that we've been trying to build, with the US, whether it was from NAFTA before or USMCA afterwards, so they tend to be counterproductive. They don't necessarily bring jobs back. And here's the kind of the flaw in all of this thinking is that, okay, so if the idea is to bring manufacturing back into the United States with unemployment at 4.1%, who are you going to hire? Like, there's no one left to hire. If unemployment was 12%, it makes sense. Saying, hey, we need to bring factories back to use up the labor slack. There is no labor slack. So this is the real challenge that we see with it, saying, okay, it's all well and good to say we want to bring manufacturing back into the United States, but who's going to work the factories?
And he's about to kick 100 million people out of the country. So
that's exactly it. So the labor market's even going to get tighter than where it is. So it doesn't make a lot of sense. And I think this is where perhaps there are good people around him saying, well, here's actually the consequence. You're going to do more harm to the U.S. economy than good if you actually go forward with this. So this is the good news. If you remember going back 2017, his first administration, anytime he would say, we have a big announcement coming in 2 weeks, there never was. Right. So the fact it's almost a positive saying, yeah, we could start them as early as February 1st. I'm hoping that what we see is that the advisors around say, maybe there are other ways to go about this. This isn't the smartest thing for the U.S. economy, which is actually operating at a very, very high level right now, doing very, very well. Unemployment is low. The economy is growing strong. Interest rates are manageable. Do you really want to ruin that by throwing tariffs on everything that's coming into the U.S.?
That's a very, very good bridge, Philip, because I'd like to start. We've got a bunch of questions coming in. I've got a bunch of questions ready for you. And that's a good bridge because we're, as I just said a few minutes ago, we're often flooded by emotion of the day, the noise, the YouTubes, and the Googles, and all the other what I would call rants or rhetorics or noise. But at the end of the day, do you guys watch? And that's a stupid question, but I think it needs to be answered here in this forum. As like, how much do you guys pay attention to the noise and the rhetorics versus the actually facts and the economic impact of the current state of the economy as we're managing portfolios?
Okay. It's a great question. And it goes into how we manage the portfolios and how we manage the upside risk with the downside risk. So we look at everything. Now, we are very data driven. Everything that we try and do in terms of the decision making, I really want to back it with the data in front of us to say we're seeing positive signs of earnings growth, negative signs of earnings growth. We see better earnings growth in this area of the world or other. We see inflationary pressures that's going to impact interest rates. And we do have to pay attention to these outside risks that may or may not materialize that we can't quantify, but tariffs. So we have to think about, okay, well, what if we see tariffs? Now, again, I mentioned it's very, very hard to quantify the actual impact. We don't know the amount of tariffs. We don't know the products that the tariffs are on. So what we try and do is hedge our bets. We try and say, okay, if we were to see tariffs, what is the worst case scenario and how do we protect ourselves for that? So a couple of things that we've done in the portfolios is if we were to see tariffs in the US, well, US small cap or small companies should do better because small companies are more focused on the domestic economy as opposed to the global economy. They're not exporters. They're selling within the US states. Okay. So they should do better if we were to see broad-based tariffs. In addition to that, if we were to see broad-based tariffs and it leads to the worst case scenario of a recession, it's possible. Well, that's where fixed income comes into play, right? So we like bonds because as we talked about earlier, bonds are paying me 5%, but if we were to see a recession, well, that could turn into 8% or 10%. So I need a little bit of a hedge for the worst case scenario that, hey, but if we're wrong and we don't see that worst case scenario, I'm still getting 5%. So I'm good there. That's the way that we have to think about it, is that we do have to consider the downside risks and build in kind of safety features into the portfolios to mitigate some of those risks. We can't avoid all of them, but we can balance them out so that if we were to see that worst case scenario, well, bonds should add value. US small caps should add value. The gold that we have in the position, which tends to be a flight to safety, that should add a little bit of value. So we can mitigate some of that downside risk, reduce some of that volatility, and put ourselves in a better position.
Good question, because one of my follow-up questions on that was oftentimes when we see when we're in a neutral position, we always see opportunities where undervaluations are undervalued. In your opinion, your sentiment, is this giving the overall environment? Is this the time to look for undervalued sectors or categories, or should we look at more of a kind of a balanced approach to mitigate the risk?
It's a balance. It's a little bit of both, right? So you don't want to ignore, for example, technology stocks are more expensive. This is the Magnificent Seven, right? NVIDIA, Tesla, Google, and so on. They're great companies. They generate very, very strong earnings growth. They have no debt. They're good businesses. So even though they're expensive, I don't want to eliminate them out of the portfolio, but I might take some profits in that area, reduce some of that exposure, and then, yes, go to the cheaper areas of the market. Now, we just did a podcast on it. You don't buy cheap for the sake of just buying cheap. You buy cheap where there is an opportunity to see growth. So there are two areas of the market right now that are really interesting to us that are cheaper than the broad market, and we think have positive catalysts to actually outperform this year. These two, both in Canada and the United States, are energy and financials. So I think the oil and natural gas, and then banks and insurance companies. Let's start with the banks and insurance companies. Mentioned earlier that longer term interest rates are going to stay, between 4 and 5%, while the Fed and the Bank of Canada continue to cut short-term interest rates in Canada in particular. So we're seeing what we call a steepening of the yield curve, where there's a difference, or long-term bonds pay you more than short-term bonds, right? As that difference increases, that's profit for the banks. The way the banks make money is they borrow short-term, lend long-term. The bigger the difference, the more profitable the banks are. We just had the U.S. bank profits come out. Great profits out of the banks in the past week. We think the Canadian banks are going to follow suit with that. So banks are a great place, and they're cheap.
Then we have, because we haven't really seen the returns have we seen in other sectors in the economy in the last 1 to 2 years.
Exactly. Banks are trading at very attractive levels, paying good dividends with great earnings. On the other side, we have energy, right? Oil companies. Now, there's a lot of talk about, well, how much oil demand is there? Trump yesterday was like, drill, baby, drill. Yeah, we got to take that with a grain of salt. Just saying to the energy companies that you can drill doesn't mean that they're going to. Reason being is that the oil companies have become far more disciplined than where they were 10 years ago, which was, drill anything and then you destroy the price of oil. They're more discerning in terms of managing their profitability. So they're only going to drill if the price of oil makes sense to do so. At near $80 a barrel, this is an attractive environment for oil companies that are trading at low levels, that are buying back lots of stock, and paying an attractive dividend. So these two areas, could actually do well in 2025.
Like I could stay here literally with a coffee and just going on back and forth about the reason of why and look at this, but I really like the fact that sometimes it gives a bird eye view for me. I try on a day-to-day basis, I have to translate a lot of this economic data and big technical discussions into the day-to-days that affects Canadian and our clients. Uh, and sometimes it's easy to say, well, don't pay attention to this because Philip, we're data driven, as he just mentioned. And we're paying attention to what matters, not on the rhetoric and the noise. And that's very important. To some of the lines that are actually wondering as well, and I did mention this before, but I failed to mention it earlier today. Philip is also the head responsible for the high profile private investments and the high profile portfolios. So that will affect many people on the call. So that's very important. We've got about 2 or 3 minutes there, Philip. Corporate profit was a big strong here last year. We're a little bit more positive, but muted moving forward. Interest rate probably a little bit more movement towards that, and obviously relies on the facts, not on rhetoric. Is a moving theme in here. Is any key point? Is anything like actually? You've been really positive and very factual year to date. Is there one or two things that keep you up at night that says, what if? What if? What would that be?
Yeah. So, very interesting on that. So we did a podcast before the end of the year on that, saying what are the downside risks, and then we balance that with the upside risks. But one of the things that we have to keep in mind for 2025, and I think this is realistic, is that it's always tricky to say, we're due for a correction, right? Because corrections can happen at any point in time. A correction is a drop in the market of more than 10%, but less than 20%. We had that in the fourth quarter of 2023, where the markets were down just over 10%. And I think it's reasonable to expect that we could see a correction at some point in 2025. Now, the reason why I say that is you tend to see a correction once every 18 to 24 months, right? And it's just a normal part of market activity. But should we worry about it? And that's the thing, because people always get a little nervous when we start to see the markets fall. But in truth, this is normal, and it gives an opportunity to reset market expectations. So should we expect a correction in 2025? Yeah, I think it's reasonable. What could trigger a correction? Look, I think a lot of the political noise that's going on right now, Sylvain, if something is said or tweeted out there that the market says, whoa, I don't like that, that could trigger correction. But here's the reality of corrections. The majority of corrections going back to World War II have an average drawdown of 14%. Okay. Should we fear that? Well, no, again, this is normal. They tend to last less than 6 months and tend to recover within 6 months. So, if we were to see a correction, it's something that we're positioned for in our portfolios. We are a little bit more defensive. We have a little bit more fixed income. And we, with a correction, if it happens, we would then shift to be a little bit more aggressive, because coming out of a correction, 90% of the time, 1 year forward, the markets are up an average of 25%. So, that actually sets up a positive environment going forward. So, we don't lay awake going, are we going to get a correction today? Are we going to get a correction tomorrow? But it is something that we're prepared for. We fully expect, and we're in the mindset to say, yeah, you know what, we're going to get some rainstorms, and we've got an umbrella, and we're good to go.
And I'm really glad you mentioned this, because on a day-to-day basis, even with or without the noise, clients are asking me, what are portfolio managers doing? What are they doing? They're obviously, when we, like, actually you and I talk, when we talk, we have this neutral positions or overweight or underweight position, and I do explain that to the clients. And this is very important that managers during time like this, during good time, take a little bit, rake off the table a little bit to reposition yourself to move forward. So this is very important to notice that obviously things happen, binge and purge process. It's not new. We just haven't invented. We're going to see this. We're going to see this moving forward. It's just a matter of, we have to put ourselves in a position to, to move on as well.
Yeah.
As Listen, I would love to keep going. I know I can't keep you live online all the time. You probably have, I don't know if we're going to see you on BNN or Business News or CBC later on today, but Philip Petursson from the Chief Investment Strategist at IG Wealth Management is one of the top media personalities in Canada in the business community. So we very, very much appreciate your time this morning, Philip. And I would be remiss not to mention the podcast available on our website, are available through the IG website, The Living Market. And where do we stand with the podcast? Do you want to give a quick shout out to the podcast there, Philip?
Absolutely, and thank you for that. It's a great way of staying in touch or on top of what we're thinking. And every single week we come out with a new topic. It's a 5-minute podcast, right? So it doesn't require a big time commitment. You don't have to, sit down and listen for 45 minutes. It's 5 minutes on what we think is relevant or interesting in the markets today. And we've been doing this for a couple of years now. We're over 100 episodes on it. It's something that we put a lot of work into. The feedback has been very, very positive. It's a nice, easy way to stay connected to how we and the other portfolio managers that we work with are thinking.
Once again, our host, Philip Petursson, Chief Investment Strategist at IG Wealth Management. Philip and I go way back. I very, very appreciate our conversation that we have all the time and in conferences and above. But I certainly appreciate you taking the time to speak to our clients today. Thank you very much.
Thank you, Sylvain. Appreciate you having me on.
Thank you very much. And we'll log off, everybody. And if you have any questions or comments following that, please feel free to reach out to us and just send us an email, and we'll go from there. Thank you, and have yourself a great day. Thanks, everyone.